to get into a little bit of math, I wanted to talk about correlation and how we use it in trading. A lot of the times it's pros, it's cons, and like why we use it the way that we do. So just as an overview, this is kind of like broadly tied into diversification. And the primary goal of diversification is to reduce idiosyncratic risk factors. And you do that by spreading portfolio capital across many different asset classes, sectors, and markets. And just for a little bit of a refresher, there's like different types of risk. We talk about risk. It's a very broad term, actually. But between idiosyncratic risk and systemic risk is just kind of like the overall risk of failure across the market, right? And you can't really control that. Like any company or market or whatever has the potential to fail because of factors that are sort of like out of control, like that are just inherent to the market itself. But idiosyncratic risk, which you can reduce with diversification, are the company or industry specific risk factors. So like my exposure to the risk factors of bonds, for example, like specifically for bonds or specifically for Apple or specifically for Microsoft, I can reduce those risk factors by using diversification. Whereas like this inherent risk of market failure, I can never really diversify away from. Does that make sense?
Makes sense.
So in order to like effectively diversify, we basically need some kind of mechanism, some kind of like statistical mechanism for measuring relationships between different risk profiles. And that brings us to the question of how exactly we do that, right?
Yep.
So I think like the first step, just from like a data analysis technique, like I think the most important step is your first step, which is actually looking at your data, right? Because the actual properties of the data are going to change what types of tools that you use to analyze them, right? The way that the data moves, the way that the data looks. You're going to use different tools depending on all of those factors, right? So I think that it's really important to first like look at your data, and then depending on how the data looks, figure out what tool in your toolbox to actually use to analyze them and apply to them, right? And so I think personally, I think that's like the most important step. And when we look at returns data, because remember that we're trying to look at relationships between different assets. And if we want to compare like the returns of one asset to the returns of another asset, a lot of the times we'll see something that looks like this. So this is a linear relationship. Here we're looking at the returns of the Qs versus the returns of SPY. And what you can see is that when SPY tends to have a big move to the upside, the Qs also tend to have a big move to the upside, likewise to the downside. And you can see a really strong linear relationship. It looks different between every pair of assets that you look at. But what this means is that if the underlying trend tends to be linear, we can use correlation to analyze this relationship. Make sense?
Makes sense.
So correlation is usually a tool that we use to actually like analyze linear relationships. It sort of breaks down when you look at like nonlinear relationships, which is part of why you need to understand when to use it and how to use it. And I think like the most common form of correlation or the most common coefficient is the Pearson correlation coefficient. So a lot of the times when we talk about correlation, we're kind of implicitly using the Pearson correlation coefficient, which measures the strength and the direction linear relationships between two variables. In our case, it was between like SPY and the Qs. It could be between SPY and gold. But when we're looking at our returns data and we want to understand the strength of that linear relationship and the direction of the linear relationship, we might use the Pearson correlation coefficient. Basically taking the covariance between two variables. So if we're looking at SPY returns and Qs returns, we want to look at sort of like the joint variability between those. It gives you information about the direction of this relationship, but it doesn't tell you about the magnitude. If you want to look at the magnitude and the direction, you need to normalize this joint variability by your different standard deviations, right, for each variable. The math is kind of interesting to look at, but you don't if you also are familiar with math, then this I think is helpful. But I don't think you really need to deeply understand this to understand like how to use it, for example, because there's a lot of programs that can calculate this, and you don't necessarily need to understand the underlying mathematics in order to do that. But I just kind of wanted to put it here for anyone that wanted to take a look at it and get some insight on that. Make sense?
Great.
Cool. So when we're looking at this correlation coefficient, it's Pearson correlation, the value of it will range from -1 to 1, with a positive number, a +1, indicating a strong linear relationship. And so here, again, in this first figure, we're looking at SPY returns versus the Qs returns. We can see our Spearman coefficient is 0.9. So that indicates a very strong positive correlation. So when one moves up, the other moves up. When one moves down, the other moves down. And that's a very, very, very clear, strong trend, right? And then compared to the, I guess, rightmost figure, a -1 indicates a strong inverse linear relationship, right? So for this, we're looking at SPY returns versus TLT, so bond returns from in 2020, like during the sell-off when that correlation might have been a little bit stronger. And here we can see our correlation is -0.48. So it's not as strong as SPY and the Qs, but we can still see that negative tendency. So when one goes up, the other tends to go down and vice versa. And we can see how the data is a little bit more spread out around this trend line, right? So that it's not as strong of a trend, but we can still get information about the strength and the direction. Does that make sense?
Yes.
Cool. And then in the middle, if we have a 0 for a correlation coefficient, that indicates no observed linear relationship. That means there might still be a linear relationship in there somewhere if we maybe look at the data over different time frames or we look at something else. But just from this data set alone, there's not necessarily a linear relationship, not an observed one at least. So here we're looking at SPY and gold, and we can see that we're just kind of seeing a blob. There's no like really distinct linear tendency here. And this kind of leads to an interesting question. If we go back a little bit, we look at some of these other data sets, we can see that there are patterns here, but we wouldn't necessarily gauge that from correlation alone. Like the circle and then the sine wave, right? Those would read as 0 correlation because there's no linear relationship, but there's still definitely a pattern, which is why that visualization is so important. Make sense?
Makes sense.
Cool. So kind of going back here, we can see how this has some applications in trading and why looking at this is maybe important. In the context of trading, correlation is really a useful tool for looking at sort of like these historic relationships between the returns of two assets. It's also useful for options traders, but it doesn't tell you the whole story since directional moves are only sort of one source of risk, where you also have like time, changes in volatility. So it's very important for options traders to look at this also, but it doesn't give you that full picture. Another kind of important note is that you probably hear this a lot, which is that correlation does not imply causation, right? It does not imply dependence. So even though the Qs and the S&P 500, they're highly correlated, it doesn't necessarily mean that they're dependent on each other because there might be some underlying third or whatever variable that is causing this correlation that we're observing. So like changes in interest rates, for example, or changes in the tech sector, for example. There might be some underlying third variable that's causing this correlation, but we can't assume a causal relationship, right? We just can observe the correlation. Make sense?
Yes.
So when people talk about correlation, not causation, that's kind of like what they're alluding to. We can observe this relationship, but we can't assume that it's causal. So why is this important? When we look at the correlations of a portfolio, this can kind of give us a sense of like where our directional concentration is, which is very important, especially if we're looking at a sell-off. On the left, we have our returns correlation for a sample portfolio from the past 12 months, and that we can see there are some that are highly correlated. Like when we look at our market indices, we got SPY, QQQ, and IWM. We can see some strong correlation in here, but we can also see like not as strong tendencies. We might see like a little bit of inverse correlation, sort of like less like low correlation between some of these assets. But overall, we can see that there's some diversification in here, right? But when we look at the same portfolio from February to May of 2020, we can see that the correlations that used to be quite weak are now quite strong. They become stronger, and things that become like that were a little bit inversely correlated become even more inversely correlated. And because like we have these big market events that can affect the directional tendencies of our different portfolio elements, that's part of why we need to sort of monitor this and pay attention to it from a diversification perspective, right?
Right.
Cool. So this is immensely helpful. It's one of the reasons that we look at correlation, but we can run into some limitations. For example, if your portfolio looks like this, we're looking, remember, at the relationships between different pairs, right? So when we look at each pair across a portfolio, you get a lot of information, right? And if you're like, oh, how much is this component going to diversify my portfolio? How much is removing this, component going to add diversification to my portfolio? It can get quite difficult when we try to scale up. So this kind of leads into our next segment that we're going to talk about later, which is that what if we could reduce the dimensionality of our data while preserving most of the information? And this is mostly going to be about principal component analysis. Has a ton of applications in machine learning, especially for traders. And I think that this is going to be like an interesting context to look at it in. But I still wanted to give this sort of like introduction to correlation, because understanding correlation and having a foundation in that is where you jump off from, right? You need to sort of start with that base.
Yes, sure.
Yes. So hopefully y'all found that interesting. We can hop back into markets now, but we got a little bit of correlation. And then I don't know about Thursday, but at some point we're going to talk about principal component analysis, which I'm very excited to talk about.